Welcome to our weekly market review brought to you by ETM Analytics and TreasuryONE. Today I'm actually joined by TreasuryONE's Head of Market Risk, Wichard Ciliers. Wichard, thank you very much for joining me today. And looking towards the week ahead, it's a jam-packed day to week as September draws to a close. And quite frankly, I actually can't believe that we're moving into October already. But all that data will just add to the narrative of the current trends that we're really seeing playing out. And one of the more significant ones that's been going on in the background is what's happening in China. We know Beijing has been struggling for a long time to really spark economic growth. It was, of course, underpinned by the collapse of their property sector, and what's been happening there added a massive debt pile to the Chinese state. That dented confidence. We're seeing dampened domestic demand. And this is, of course, all happening against a backdrop where there's this global slowdown due to the tight monetary conditions, but also China's involved in a trade war with the West. So really not a rosy picture for China. But then the powers that be in Beijing came out last week with the big guns of stimulus, as they're still trying to get to that 5% growth target for the year. And the Chinese stock market went boom.
Yeah, good morning to everybody. Yes, Ilze-Marie, the Chinese economy is struggling. Their housing starts is down 65%. The widely spoken about property sector has been under pressure. We've had headlines, evergreen, all those properties. It's been all out there. Then last week, they introduced 2 trillion yuan worth of stimulus to try and boost the economy. And over the weekend, they've also Shanghai, Shenzhen, and I can't pronounce the other one, but I'll try Guangzhou. They are gonna reduce interest rates on home loans there as well to be implemented in the month of October to actually be below the People Banks of China's rates to try and stimulate the economy. So they're pushing in a massive amount of stimulus, the biggest since the 2008 financial crisis. So it just tells you how big the problem is. But now that excess liquidity, we've seen it in the US market when they printed up to like $5 trillion and stimulate the economy. The S&P 500, Nasdaq went ballistic. And we've seen that excess liquidity just find a new home in the Chinese stock exchange. So is it really going to help, or are we just inflating another asset bubble at this stage? It's something we need to keep a lookout for. The other thing is what we can help us as well is if the demand for commodities picks up. That will definitely help South Africa. But it will help in terms of trade because oil is down at these levels, and if there's demand for copper, iron ore, and all this thing comes back, and we're a big exporter of that, that can also help the rand. But we've already seen the rand being helped along by the stimulus package. So it's definitely a market that we need to keep our eye firmly upon. Is how the Chinese are going to stimulate and get themselves out. Because the 5% growth target is definitely not going to be achieved this year. It's going to be difficult. And 5%, even though they grow at 4%, it's still double than what South Africa is growing. So it's still growing, but not at the pace of the double digits and 8s and 9s that the Chinese government wants.
Yes, and not only what the Chinese government want, but the global community kind of have been relying on for the past decade or two was this massive growth in China. And obviously, and you mentioned it, the danger of what they're doing is that they are just propping up, because they are staring deflationary trends in the face, whether or not the stimulus measures will just keep on propping up the economy without really boosting productivity and efficiency. And we get that bubble again. And it's a very similar situation that, for example, we saw play out in Japan as well. So, I know it's the biggest economy. They're still growing, but it's definitely a lot of red flags coming out of China that everyone, I think, just needs to keep an eye on, especially given the global backdrop that we're operating in. But like I mentioned, a slew of labor data coming out this week. Most notably, it's the end of the month, so we are looking for US labor data. ADP starting on Wednesday. Then we have the non-farm payrolls on Friday. And we are still, I think we're still agreeing that we're going to see this kind of loosening of the labor market continue. The question, of course, is by how much, because that will influence what Mr. Powell will do at the next meeting. How deep will the cuts be?
Yeah, so you mentioned all the red flags in China, but there's definitely some red flags in the US as well. And some of it, that's where we saw the first 50%, 50 basis point rate cut in the US is because of the red flags and the labor data that's coming out. So they're still expecting the September jobs report and non-farm payrolls to come out and print 146,000 still growth. But you can see here from the graph, it's graphically growing at a slower pace. They're expecting unemployment to remain at like 4.2%, not pick up. And average hourly earnings actually been growing above inflation, which is actually not good for inflation to trend longer term. So we'll need to keep an eye on it. But it's like I said, it's red flags. They're worried about the economy. They're worried about the labor data. All the recessionary red flags is there. And if this doesn't come out as expected, unemployment ticks up to 4.3, 4.4%, and payrolls is negative and all of that, maybe the market's already aggressively pricing 75 basis points worth of hikes for the rest of the year. It's a 50 and a 25 in the upcoming two meetings, while Jerome Powell and the Federal Reserve communicated in September they're only going to look to do another 50. So the market is pricing more aggressively than what the Fed is speaking. So very important data that's going to come out. We need to keep an eye on it. If any upticks comes out, unemployment higher and payrolls lower, maybe that 50 in November is going to be more significant being priced than it's currently being priced.
And obviously, that's what we're looking for, to figure out where the SARB locally will also head into. We actually had a discussion in our meeting this morning about inflation in South Africa really trending lower. We could possibly go even below 3% by the end of the year, and this could maybe see Kganyago move outside of his more conservative cuts that he's become known for even. We know that South Africa has been behind the curve when it comes to relative to its other emerging market peers. So it's going to be, it's like you said, an interesting data flag to keep track of, not only for the US, but also obviously for what we're expecting locally. Speaking of locally, the Rand has been riding a good wave of everything that's been going around. The question is, I want to know is, could we breach below the 17 Rand band at some point?
Yeah, so we've talked about the stimulus, the interest rate cuts, our Reserve Bank governor being more conservative, and our Reserve Bank governor being more conservative, hence part of one of the reasons why the Rand strengthened, because we've only got one meeting left. The Federal Reserve's got two left. So if Jerome Powell cuts by 50 basis points in November, and our meeting, and even if we cut 50 basis points, we'll still be behind the curve. And then they've got opportunity to cut again in December, the Federal Reserve. So the interest rate differential definitely widens. We've widely spoken about the GNU that's helped along, and all the positive signs, the green shoots. And
we have electricity.
We've got electricity for 4.5 months now. We've got our medium-term budget speech coming up. And if you read between the lines, it looks like tax revenue collection is in line. It's not beyond the curve. So all in all, it looks positive. So can we breach 17? Yeah, it's a possibility. But I think the move is becoming a bit stretched now. I think from 5 August, when we saw the blip, when the whole yen carry trade started to unwind, and the Rand was at 1860 to where we are currently at 1710. We were briefly at 1705 this morning. It's an 8.5% stronger move. And for the last 14 days, we've been moving one direction stronger. Every day we open, we end the day stronger. We open, we end. So it's that little rubber band's just been stretched a little bit too far. So I think there must be a period of consolidation, maybe a little bit of weakness back again. But longer term, if everything continues and the Reserve Bank remains conservative, the Fed cuts, bar a massive hard landing and a global meltdown, I think the Rand can probably go 1680, 1675. But I think it will be a good opportunity for importers. I think I spoke to George from ETM as well last week, and I think we need to adjust our range. We've been advocating 1750, 1850, but with all the positive shoots, the stimulus, the interest rate cuts, how it's been paid out, the Rand sort of going to be more comfortable in 17 to 18 for this stage, with periods where it's going to break out. So, and probably oscillate more towards around the 17 than the 18 level within that range for the next couple of months. So, yeah, there's a lot of positive factors for a change that's going South Africa's way. So, and they say the trend's your friend. So let's just ride the wave at this stage.
George mentions, he calls it feels a bit like a Goldilocks moment. And we're kind of sitting waiting for, okay, where's the bubble going to burst? Where's the wobble going to come? Because it feels like a Goldilocks moment. It almost feels too good to be true. And how everything is operating. But there's still a lot of red flags. There's a lot of risk baked in. We're seeing the geopolitical tensions escalate in the Middle East as well. So there's definitely various and several probable risk factors that can cause some speed wobbles in the market. So we'll be keeping an eye on from that. But other than that, Wichard, thank you very much. And I'm guessing I'm being joined by Ciliers again next week.
Yes, he'll be back next week. He's just on the road today, visiting clients. So yeah, we'll speak again next week. So, like I said, there's red flags. There's red flags in the rand as well. Because if that wobbles happens and the US comes in for a hard landing, there will be a flight to safety, and one of the flights to safety will be the dollar. So let's just keep watching the data and see what happens this week.
Thanks, Wichard.